So if you're retired and you need to supplement your income, this is a tool that might require some serious consideration. It enables you to take advantage of the cash without monthly loan payments. So the pluses, no monthly payments, you remain in your home, and the loan is repaid when you sell or pass away. Welcome to the Carolina Senior Talk Podcast, your trusted source for all things related to senior living in the Carolinas. In each episode, we'll guide you through the best locations, offer advice on buying a home, and share tips on relocating within this beautiful region. Whether you're exploring new senior communities, considering a move, or looking to invest in your current dream home, we've got you covered. So sit back, relax, and get ready to discover everything you need to know about senior living in the Carolinas. Well, hello there. Dave Edwards with Welcome Home Properties and host of this latest episode of CarolinaSeniorTalk.com. This is podcast number 6, and welcome. I hope you find this enjoyable. I'm going to be talking to you today about sources of equity. This is often the most understated, underestimated, inaccessible source of wealth that we've accumulated in a lifetime. And we are afraid sometimes to tap it or understand how to utilize that. So these are the top 10 ways to take advantage of the equity that you've earned in your present home. So we'll talk about what the technique or approach or method is. We'll talk about when it's best to use it and what are the pluses and minuses of each alternative. So let's talk with the first one, which is something we've all heard about. It's a home equity loan. It's a very simple loan. It's a lump sum loan. It's secured by the home's equity, and it's typically paid back in fixed monthly payments over a set period of time, the term of the loan. So if you're in a situation where you need a large influx of cash, this is great. So if you've got a situation where you have a home renovation or you want to update a portion of your home or consolidate debts, all these are good examples of how it's been utilized in the past. I always recommend if you've got a horizon of 4 or 5 years out, you've got time between now and then, and that might be opportune situation to maybe update something that would be of value to you and your lifestyle. So there's nothing like having an updated kitchen, for example, to enjoy. So you're receiving personal enjoyment, but you're also increasing the ultimate equity of your home because that's what buyers want to see when they go out there and buy homes. Obviously, updated kitchens, updated bathrooms, maybe patios, things of this nature are things that are very attractive to buyers and increase the value of your home, thereby your equity ultimately of your home. So things to keep in mind. Pluses and minuses of this alternative, well, you've got a fixed interest rate and therefore it's more predictable, and you can borrow a more significant amount versus alternatives. On the downside, okay, it's tied to your home is your collateral. So like a lot of loans out there, if you fail to make a payment or payments on that, you understand that foreclosure is the end result of that. So it's a risk. Home equity line of credit. Very similar tool, except in this case, it's a revolving line of credit. It's based on the home equity, of course, and it's if you've got expenses that are unpredictable or they're ongoing. An example that I've given here would be home repairs or medical bills or things of this nature. This is a tool that you might want to utilize in that situation, and it's very simple. You simply borrow what you need when you need it. The pros on this, the pluses, it's flexible. That's the key word. The flexibility of this is unparalleled. It's typically lower interest rates than the alternative as well, than a credit card. On the negative side, okay, you have variable interest rates, which can lead over the life of your use of this to higher costs over time. Conversely, if you're in a market where you have declining home values, and sometimes we have those in pockets of the United States, we've went through a period of time back in '07, for example, where the market was declining. Well, you might end up with available credit based on less opportunity there. How about a refi? In this case, a cash out refi. So a refi is just simply recasting your existing loan. In other words, you're replacing it, your current loan, with a larger one. And the difference is your equity. And a cash out, it implies just that. Now you're taking that difference out in the form of cash. The old loan is paid off, the new loan is in place. So when do you use this? Well, it's a great opportunity to take advantage of lower interest rates, or take advantage of consolidating your debts. Okay, that's a wonderful use of that tool. The pros, the lower interest rates obviously makes it very entertaining, and it's certainly less than the alternative of credit cards or personal loans. So those are the two major advantages. The disadvantages is that your closing costs are going to be higher, and you're resetting your mortgage. So now, over the life of this new loan, in addition to what you have been paying, you are going to be paying increasing amount of interest potentially over the life of that loan. It just depends because you might be at a lower interest rate. So that's a possibility there. All right, here's one that is targeted, okay, designed for those of us that are age 60 or older. Specifically, age 62 is the minimum requirement and enables you to convert. So it's called a HECM because it's home equity conversion mortgage. So you're converting what you have in terms of equity into cash today. So you're taking advantage of the equity you have, a portion thereof, and converting into cash without selling your home. You do not need to sell your home. When does it get repaid? Well, it gets repaid when you either sell the home or you pass away. So if you're retired and you need to supplement your income, this is a tool that might require some serious consideration. It enables you to take advantage of the cash without monthly loan payments. So the pluses, no monthly payments, you remain in your home, and the loan is repaid when you sell or pass away. The downside is that your heirs will inherit less. That's the plain fact. There are some basic requirements that you've got to maintain the home and you've got to continue to pay property taxes. So that's a reverse mortgage or HECM. How about selling and downsizing or right sizing? Okay, if you sell your home, the benefit there is that you are utilizing the equity to buy a smaller or more affordable property or other financial needs. Case in point, we sold our last home and we used that equity to buy down the amount of the mortgage. And we also used a portion of our equity to do some things to the new home that we wanted. You know, we wanted closet systems. We wanted it painted before we got into the home. Um, Things of this nature, a larger patio. Okay, so that's how we used that equity for other financial needs. So it's great if you want to reduce your expenses, if you want to move to a smaller space or to an alternative space, or you're seeking conveniences of a different community. Okay. So if you want to access the full value of your home equity, this is something to consider. You have the potential to reduce your living costs and maybe gain a desirable or different or more desirable lifestyle. On the negative side, okay, it requires you to move. I mean, so that entails going through the logistics of moving, the expenses associated with moving, and possibly any renovation like we had, okay, or improvements to the property that we were moving into. So you just need to think through those things. The shared equity agreement. Here's something that many people have not heard of. I've never, as a realtor, run into this, but it does exist. So basically, what you're doing is you're selling a portion of your home's future appreciation, your future equity, to a third party, an investment firm, in exchange for which you're receiving cash, and you are not taking on debt. So if you want to avoid the monthly loan payments, this might be an alternative for you, or if you need to tap into that equity without incurring additional debt. The pros, no monthly payments or interest charges, and terms are flexible. But keep in mind, you are trading away the future of value. And oh, by the way, in a highly appreciative market, okay, that cost is going to be higher because they're receiving a percentage of your future equity. And so their gain is greater as well as yours. But just keep that in mind. It's a balance there. Here's something that we utilize as realtors frequently when we're transitioning from one property to another, and this is called a sale leaseback. And when you're in a strong seller market, we use this also very frequently. But let's say we want to buy time. My seller might need to stay in the home and they want to move once, and maybe they haven't found the home they need quite yet. So they need a little bit of time to find that home, or they need to buy time before they can settle on that next home. So this tool enables you to sell your home to an investor or to a buyer and lease it back. And that lease is a negotiation. It could be a fair market value on rent, or it could be $1. But it basically enables you to access your equity without moving out immediately. The key word there is immediately, because it's ideal for those situations where you are working with a limited amount of time. You need to cash out today. It also gives you certainty to the seller, because now you have the money in the bank, okay? And now you can go forward with an offer on a future home or apartment or dwelling of your choosing, okay? You're tapping the home equity without relocating immediately, and you are giving yourself the ability to make a stronger offer because you're competing. Remember, you're competing for that second property, that second home often. And so a stronger offer is made by the fact that it's a non-contingent offer. Basically, you're buying time as well. The downside, you're going to have to move again. That's part of the equation, but I think we know that. And the lease terms are negotiable. They could be unfavorable. And that's the advantage of having a realtor involved, is that we look out and represent you as a seller and your best interest to make sure that those terms are reasonable and fair to you and flexible, because you don't always know at this point when you are going to be able to settle on that next property. So we have to negotiate those details. A bridge loan is another alternative. It's temporary financing. It's a short-term loan. But when your home has not sold, it's still in the market, it enables you to tap into the equity, obviously not as much, but it's based on the equity to purchase the new home. So while your old home is still on the market. So if you're transitioning between homes, this is an alternative for you, but it's temporary financing. The pluses, okay, allows you to secure a new home without selling your current one. And the negatives, well, the higher interest rates and fees associated with a short-term loan. Those in short are the negatives. A second mortgage is when you go in and basically do it exactly as it implies. You have a first mortgage on the property, and now you're coming in and putting another loan on the property. You've got equity to enable that to happen. Okay, but now you have an additional loan. It is subordinate to the first mortgage, and it's often structured just like a HELOC or a fixed loan. Great for situations where you need the funds, but you want to keep your first mortgage intact. It's terrific for situations like before, where you have improvements that you want to make, for example, on your home, that add value to that home. So you can access the cash without altering the first mortgage. The downside is that, relatively speaking, the interest rates that you're going to receive for that second mortgage are going to be higher than the first mortgage. And once again, it's tied to your home. So if you miss payments, okay, a second mortgage can foreclose on the property. So you have to make those payments. Last but not least is really creative financing. It's really not financing, because when we talk financing, we're talking money. Well, in this case, we're talking income, and then we're talking utility, the equity that you have in the form of utility of your property. So if you're a single individual, perhaps you're a widower and you've got abundant space, extra space in your home, it could be in the form of a basement or an apartment over a garage or something of this nature. Why not rent that out and generate additional rental income in so doing? Okay, so now you're taking advantage of the utility equity, if you will, in your home and gaining income. So if you get extra space and you want an additional steady stream of income, this is a great tool to consider. And if you're on fixed income in particular, this can be a lifesaver. So the pluses: generates income while keeping your home. You have also some potential tax benefits there. Talk to your CPA on that one. Here's an intangible that I think is very important and often overlooked, and that is the companionship, the social aspect that you gain if you're single or you're just a couple and you're empty nesters. And here you are gaining the companionship of some friends, maybe some younger people around. What a wonderful way to do that and generate income. Now, They may be friends. They may not. They may be people that you get off of the internet. Who knows? But in the end, you need to treat this like a business. You are a landlord. There are certain uh, behaviors and conditions that have to be met, and you need to define those in writing. So you have to manage this landlord-tenant relationship. There are some legal and some insurance considerations also that you need to have conversations with your attorney and your insurance broker as well. But if you do that, this could be a wonderful way to take advantage of the utility that you still have remaining in your home, generate some income, and gain some companionship. So, my friends, I hope this was helpful to you. Here are the 10 ways again. So, a home equity loan, equity line of credit, a refi, cash out refi, reverse mortgage, selling and downsizing, sharing the shared equity where you're selling a portion to an investor, a sale leaseback, a bridge loan, a second mortgage, and simply renting a portion of your home. Those are wonderful ways to take advantage of the equity in your home. My friends, if you have questions about the equity or how to utilize that, no matter what your horizon is to deal with your current property, whether it's stay or move in time, it all starts with how much equity you have in your home. And I would welcome a phone call to have that conversation. No strings attached. You just give me a call. We'll come out and we'll do a property analysis, and I'll get down to very specific valuation of what you have in that home. So now you have the information to make an informed decision. I hope this has been helpful. Catch you on the next podcast. You take care. Thank you for tuning in to the Carolina Senior Talk podcast. We hope you found today's episode both informative and helpful. Be sure to subscribe to our podcast so you never miss an episode. If you enjoyed today's show, please leave us a review and share it with those who might benefit from our advice. If you or anyone you know is looking to buy, sell, or relocate to the Carolinas, or you simply want to know how much equity you have in your home, be sure to contact me at www.carolinaseniortalk.com. Until next time, we wish you the best on your senior living journey in the Carolinas. Take care. Thank you for listening once again, and talk to you soon.